The financial markets are incredibly noisy, right? They're always throwing signals at us, telling us where the economy might be going. But what if I told you there's one signal that is so uncannily accurate, people call it an oracle? Well, today we're going to decode its secret message. We are talking about the yield curve. So here's our game plan. First, we'll talk about why the free lunch for savers is coming to an end. Then, we'll put on our detective hats and decode the yield curve itself. After that, we'll get into something called the bond price seesaw. This is a really key concept. Then we'll cover the inaction trap that catches so many people off guard. And finally, we'll pull it all together so you can figure out your next move. Okay, let's just dive right in and talk about the cozy reality a lot of savers have been enjoying. For the last couple of years, things have felt, well, easy and safe. But that's all about to change. This right here, this is the heart of it. Getting a comfortable 5% return on your cash felt great, didn't it? But that was never meant to last. It was a temporary fix, a direct result of the Fed's aggressively cranking up rates to fight inflation. Now, the economic winds are shifting, and that free lunch special is off the menu. Look, a high-yield savings account feels like the safest place on earth, but it's hiding a silent killer: inflation. Think about it. Even if you're getting a 5% yield, but inflation is running at 3%, your real return is only 2%. And what happens when the Fed starts cutting rates and your yield drops, but inflation sticks around? Suddenly, your purchasing power is actually going down. Sticking with what used to be safe is a strategy that now risks locking in a real-world loss over the next decade. So, the big question is, if stashing cash isn't the smart move anymore, where do you go? Well, the answer isn't screaming at you from the headlines, but the bond market is sending a massive clue. And that clue is the yield curve. Let's dig in. All right, time for the main event. I want you to think of the yield curve as more than just a graph. It's the market's crystal ball. It's the collective wisdom of millions of investors, all forecasting the future. And learning to read it is one of the most powerful skills you can have. So what is this thing really? It's actually way simpler than it sounds. The yield curve just plots the interest rate you'd get for loaning your money to the US government for different amounts of time, everything from a few months to 30 years. The line that connects those dots, that gives us an incredible snapshot of the economy's health and, more importantly, where it's probably going next. Now, this is where it gets really cool. The shape of that line tells a story. Look here. A normal curve slopes up. That means the economy is healthy and you get paid more for locking up your money for a longer time. Makes sense. A flat curve, that means uncertainty is creeping in. But the one we really care about today is the inverted curve. This is when short-term rates are actually higher than long-term rates. This is rare, and it is a powerful, powerful signal. It's the market basically screaming that the Fed's current interest rates are too high, that a slowdown is coming, and that rate cuts are on the horizon. And listen, this isn't just some theory. This quote from our source material backs it up. An inverted yield curve has come before every single U.S. recession in the last 50 years. But here is the critical insight for us. It doesn't just predict a slowdown, it predicts the response to that slowdown, which is the Federal Reserve stepping in to slash interest rates. And that prediction, that's where the opportunity is hiding. Okay, so the oracle is telling us rate cuts are coming. Great. But how do you actually turn that into a strategy? This next part is the absolute key. It's a simple mechanical truth about how bonds work, and it's the answer to the whole riddle. This is the golden rule. If you remember one thing from today, make it this. Just picture a seesaw in your mind. On one end, you have interest rates. On the other end, you have the price of existing bonds. When interest rates go down, the price of older bonds, the ones that were issued when rates were higher, goes up. Your old bond, with its juicy payout, suddenly becomes way more valuable. Let's walk through an example to make this super clear. Let's say you see the inverted curve and you buy a 30-year bond for $1,000 that pays a 5% coupon. A year goes by, and just like the curve predicted, the Fed starts cutting rates. New bonds are now only paying 4%. Well, guess what? Your 5% bond is now the hot ticket in town. Its market price could jump to something like $1,225. That's a potential 22.5% profit just from the price change, and that's on top of the interest you've been collecting all along. That's the seesaw in action. Now, there's another layer to this. Not all bonds are created equal on the seesaw. The longer a bond's maturity, the more sensitive its price is to changes in interest rates. The technical term is duration, but just think of it like a longer lever. A small push on one end creates a huge movement on the other.
A tiny dip in interest rates has a much bigger price impact on a 30-year bond than a 2-year bond. Why? Because you've locked in that higher interest payment for so much longer, making it that much more valuable in a world of lower rates.
So, the path seems pretty straightforward, right? You decode the signal, you understand the seesaw, and you make your move. But this right here is where most investors get it wrong. They fall right into something called the inaction trap. Here's the brutal truth of it all. The market does not wait for the 6 o'clock news. The big money, the pros, they're acting on the prediction from the yield curve, not the official announcement. By the time the Fed chairman gets on TV and says, "We're cutting rates," it's already old news. That big price jump in bonds, it's already happened. Most retail investors wait until after the first 1% of cuts are done, and they completely miss the profit from the price appreciation. If you wait for the headlines, you've missed the opportunity, period. So really, it boils down to two paths, two choices. You can take path A, stick with cash, and just watch your returns get smaller and smaller as the Fed cuts rates, all while hoping inflation doesn't eat away at your savings. Or you can take path B, act on the signal from the yield curve, lock in today's amazing bond yields for years to come, and position yourself to potentially profit from those price gains. The outcomes are dramatically different. And this quote just nails it. The bank feels safe. It feels like a fortress. But in a shifting interest rate world, that safety is an illusion. The real risk isn't that the market is volatile. The real risk is the slow, silent, guaranteed erosion of your wealth as your cash yields fall and inflation marches on. Okay, we've decoded the message, we understand the mechanics, we see the trap we need to avoid. Now, let's bring it all home and talk about how to put this into action. Let's talk about your next move. So let's recap the strategy. First, the free lunch of high cash returns is over. Second, the inverted yield curve is giving us a historically reliable heads up that rate cuts are coming. Third, we know that when those rates fall, existing bond prices will rise. And fourth, we know that waiting for the news means we've missed the party. So the key move to consider is extending your duration, basically moving from that short-term cash into intermediate-term bonds. We're not just talking about any bonds, but finding that sweet spot, maybe in that 5 to 7 year range, where you can lock in today's high yields and give yourself the best shot at those price gains. It's about trading the illusion of safety for a calculated opportunity, all based on one of the market's clearest signals. So I'll leave you with this. The oracle has spoken. The yield curve is telling a very clear story about what is likely coming down the pike for interest rates. The only question left is, are you listening? And maybe more importantly, is your portfolio positioned to answer the call?